Welcome to this deep dive. Today, we are taking a really granular look at an excerpted guide. It's titled The Architecture and Economics of Funds of Funds.
Yeah, and our mission here is really to demystify this financial vehicle that, it sounds incredibly complex on paper,
Oh, totally.
but it might just be like the ultimate shortcut to extreme portfolio diversification.
Right. And, have you ever wondered how regular, everyday retail investors can actually get their hands on exclusive, highly speculative hedge funds?
The kind usually reserved for massive institutional capital.
Exactly. The secret key is something called a fund of funds or, an FOF.
It's a structure that fundamentally changes the rules of access. It completely redraws the traditional boundaries of who gets to deploy capital into these alternative asset classes.
Think about the highest echelons of wealth, right? Where there is always this imagery of the velvet rope.
Oh yeah, the VIP sections.
Exactly. You have exclusive country clubs, VIP lounges, private equity rounds, and for the longest time, the financial world just operated on that exact principle.
It really did.
There was the traditional equity and bond market for everyday people, and then firmly behind a thick velvet rope were the alternative investments,
The hedge funds.
the distressed debt market.
Right, the places where the risk profiles were wilder and the alpha was supposedly, much higher.
But the FOF creates a backdoor, like a highly structured way for you to bypass that velvet rope entirely.
Which is huge.
Okay, let's unpack this, because before we can really evaluate the perks and the structural traps, we need to understand the underlying architecture of what we are dealing with.
We do.
How is an FOF fundamentally built compared to just a standard investment vehicle?
Well, to grasp the architecture, you really have to shift your perspective on the role of the portfolio manager.
Okay.
When you buy into, say, a standard mutual fund or an ETF, the capital pool is directed at the security level.
Meaning they buy specific stocks.
Right. The manager is analyzing and purchasing individual corporate bonds, sovereign debt, or like shares of Apple and Tesla.
Makes sense.
But a fund of funds operates a layer above that entirely. It does not touch individual securities.
Wait, really? So no individual stocks at all?
None. Instead, it aggregates capital to purchase a portfolio of other investment funds. It allocates into mutual funds, ETFs, private equity vehicles, and crucially, hedge funds.
Wow.
The overarching objective is just unprecedented diversification. You are spreading capital not just across hundreds of equities, but across hundreds of entirely different asset classes.
And managed by entirely different teams. Yeah.
Exactly. Completely different sub-advisory teams deploying entirely uncorrelated strategies.
When analyzing the source material for this, a very specific visualization came to mind.
Oh, yeah.
Yeah, an FOF essentially operates like the Russian nesting doll of the finance world.
Oh, I like that.
Right, because you purchase this one large overarching doll, but when you open it up, there aren't individual stocks inside. There's another smaller fund.
Right.
You open that one, and it's, I don't know, an emerging markets sovereign debt fund. Open another, and it's a long-short equity hedge fund.
That's a great way to picture it.
Or, to use a more modern analogy, it's essentially like a Spotify playlist constructed entirely out of other people's specialized playlists.
Yes. What's fascinating here is the sheer scale of human capital and professional management required to maintain that nesting doll structure.
It must be massive.
It is. The overarching manager of the FOS, the allocator, they function as a macro maestro,
The
essentially.
macro maestro.
Yeah, because their primary skill isn't security analysis. It's manager selection and capital allocation.
Right, they're picking the people who pick the stocks.
Exactly. They're constantly adjusting the macroeconomic dials, deciding whether to rotate capital out of the aggressive growth sub-funds and into the defensive market-neutral sub-funds based on the current economic cycle.
That actually creates an incredibly convenient value proposition for the investor.
Absolutely.
You make a single asset allocation decision, purchase one ticker symbol, and instantly deploy an army of financial professionals across every conceivable asset class.
It's very appealing.
But let's return to the concept of the velvet rope for a second.
Okay.
Because an FOF is essentially a wrapper for other funds, how does it systematically interact with hedge funds? Because those are notoriously restrictive and, exclusive by design.
Well, the mechanism relies on bridging two vastly different regulatory frameworks.
So.
So hedge funds deploy highly speculative tactics, massive leverage, naked short selling, exotic derivatives.
The really risky stuff.
Right. And because of that systemic danger, they operate largely outside the stringent constraints of the Investment Company Act of 1940,
Okay, so less regulation.
much less. They have minimal disclosure requirements and, honestly, structural opacity. However, the regulatory trade-off is that they are strictly limited to accredited investors or qualified purchasers.
Meaning you have to be very rich to play.
Exactly. Institutional capital, or high net worth individuals who have the balance sheet to absorb a total catastrophic loss without causing a retail market panic.
The traditional velvet rope barrier we talked about?
Precisely. FOFs, conversely, are typically registered as standard 40 Act funds.
But they are regulated.
Highly regulated. They're tightly regulated by the SEC. They face stringent reporting requirements, and therefore they're open to retail capital.
Any everyday investor.
Right. And because the regulatory framework allows a registered FOF to allocate a portion of its portfolio into unregistered hedge funds, it effectively wraps restricted strategies in a retail-accessible wrapper.
Oh, wow.
Yeah. Anyone listening could deploy capital into an FOF today and indirectly hold a stake in a macro hedge fund that would otherwise require like a $5 million minimum buy-in.
Here's where it gets really interesting.
Yeah.
Because I have to push back on the regulatory logic of this architecture.
Go for it.
If the SEC restricts hedge funds specifically to quarantine their high-risk, catastrophic speculation away from retail capital.
Right. Isn't an FOF buying into a hedge fund just a textbook case of regulatory arbitrage?
It sounds like it, yeah.
I mean, it feels like slapping a warning label over a hazardous product and just handing it to the exact retail demographic the regulations were designed to protect.
This raises an important question regarding systemic risk. On the surface, the optics certainly point toward a loophole.
Yeah, a massive one.
The regulatory justification, however, hinges entirely on the mathematics of risk dilution and cross-asset correlation.
Okay, break that down for me.
So sure, the FOF macro allocator is not taking the entire retail capital pool and just dumping it into a highly levered, concentrated hedge fund.
Right, that would be insane.
Exactly.
Yeah.
They are taking a fractional slice, perhaps like 5% of the total assets under management, and allocating it to that hedge fund.
And the rest?
The remaining 95% is heavily diversified across fixed income, large cap equities, and low beta assets.
So the extreme volatility of the alternative asset is kind of suppressed by the sheer mass of the broader portfolio.
Exactly. The overarching portfolio's risk profile is fundamentally transformed. If that specific hedge fund experiences a blow-up and loses, say, 60% of its value.
Ouch.
Right. But the impact on the total fund of funds is negligible. The retail investor might see a slight dip in their quarterly statement, but their downside is heavily insulated.
Oh, I see.
The structure allows retail capital to capture a fraction of the uncorrelated alpha generated by alternative assets without being exposed to the concentrated, ruinous downside of holding the asset directly.
Okay, accessing institutional-grade alternative assets coupled with massive, dynamically managed risk dilution, it sounds like a utopian investment vehicle.
It does on paper.
So we have to examine the structural friction. Why isn't every portfolio exclusively constructed using funds of funds?
Well, in capital markets, friction is inevitable, and the very architecture that gives the FOF its massive diversification also creates its most punishing drawback.
The catch.
Yes, the catch. The source material outlines significant structural headwinds, but the most aggressive wealth destroyer embedded in this model is the compounding layers of fees.
So what does this all mean? Let me frame it with another analogy, if you don't mind.
Yeah, go ahead.
Investing in an FOF is sort of like paying a massive premium for a VIP ticket to an exclusive theme park.
Okay.
You pay a substantial entry fee just to get through the main gates.
Yeah.
But once you are inside, you discover your VIP ticket doesn't actually cover the attractions.
Oh, man. Yeah.
You still have to pull out your wallet and pay an individual premium every single time you want to ride a roller coaster. At what point does the structural cost of maintaining the VIP pass just obliterate the value of the convenience?
If we connect this to the bigger picture, we have to run the actual mathematics of multi-layered fee compounding.
And it's not pretty, is it?
It's really not. When you deploy capital into an FOF, you pay an overarching management fee to the macro allocator.
Right, the person running the overarching doll.
Yes. But peering back into the nesting doll, every underlying mutual fund, ETF, and private equity vehicle charges its own internal expense ratio.
Because they have their own managers.
Exactly. And if the FOF allocates to hedge funds, you are absorbing their notorious 2 and 20 structure.
Remind me what that is.
That's a 2% management fee plus a 20% performance fee on any profits.
So you are literally stacking multiple active management fees on top of the exact same dollar of deployed capital.
And the drag is severe. The source material highlights that this double-layered structure creates a massive hurdle rate.
Meaning the fund has to earn a lot just to break even.
Right. A typical FOF investor might face an aggregate expense drag of 2 to 3% annually.
Wow, 2 to 3% every year.
Just to break even. If the broader market generates an 8% gross return, your net return after a 3% fee drag is only 5%.
That hurts.
And over a 30-year investment horizon, that difference doesn't just trim your profits. Compound interest math dictates it will consume hundreds of thousands of dollars of your potential wealth.
That is staggering. But the structural costs go beyond just expense ratios, right?
They do.
Because the guide also heavily emphasizes the cost to your capital flexibility, specifically illiquidity.
Yes, the illiquidity trap.
We are talking about a severe mismatch between the liquidity expectations of a retail investor and the reality of the underlying assets.
The structural mismatch is a massive hidden risk. Retail investors are accustomed to daily liquidity.
Like selling a stock on your app.
Right, the ability to liquidate an ETF and have the cash settle in milliseconds. But remember what the FOF is actually holding.
The hedge funds and private equity.
Exactly. It has capital locked inside private equity vehicles or distressed debt funds that operate with multi-year lockup periods.
Oh, wow. And when a macroeconomic panic hits, those underlying funds often trigger gate provisions, don't they?
Yes, legally freezing withdrawals to prevent a run on the fund.
So what happens to the retail investor?
Well, when the underlying assets freeze, the overarching FOF becomes illiquid by default.
Because the money is physically stuck.
You got it. You cannot liquidate your shares because the FOF manager physically cannot access the capital from the sub-advisors.
That is terrifying.
If your capital is locked in an FOF during a market downturn and you face a sudden liquidity need, you are trapped.
Yikes.
Furthermore, to try and prevent this, FOF managers often hold a significant portion of the portfolio in pure cash just to meet potential retail redemption requests.
Which means that cash isn't invested.
Right, and that cash drag further suppresses the portfolio's overall return.
And then there is the phenomenon of redundant holdings, which, reading the source, completely undermines the core selling point of diversification.
Oh, this is a huge issue.
This happens when an investor tries to manually balance their portfolio by allocating across multiple different funds of funds.
Exactly. They might purchase, say, FOF Alpha for aggressive tech exposure and FOF Beta for conservative value.
Sounds smart on paper.
But the overlap probability approaches 100%.
Why is that?
Because FOF Alpha might hold 3 different underlying mutual funds that are all heavily overweight in a megacap like Microsoft.
Okay.
FOF Beta, managed by an entirely different firm, holds a collection of ETFs that are also overweight in Microsoft.
Oh, I see where this is going.
The retail investor ends up heavily concentrated in a single security, completely unintentionally.
And worse, they are paying active management premiums to 2 different overarching allocators and dozens of sub-advisors just to hold identical positions.
It is diversification at its finest.
Diversification, that's the perfect word for it. So, navigating this multi-manager landscape requires some serious structural awareness.
It really does.
Given the punishing fee layers, the liquidity traps, and the overlap risks we just discussed, how does an investor practically vet a multi-manager portfolio without just sabotaging their own compound growth?
Well, the source material provides a roadmap for vetting, starting with just a basic nomenclature.
Because they don't call them FOS anymore, right?
Right. You rarely see the term fund of funds on retail marketing materials today. Investors need to scan their options for terms like multi-manager investments, multi-manager portfolios, or very commonly, target date funds.
Target date funds, everyone has those in their 401k.
Exactly. Once identified, the critical step is aligning the multi-manager structure with your specific risk parameters.
And the text highlights John Hancock's multi-manager portfolios as the industry standard model here, doesn't it?
It does. They offer a spectrum that utilizes glide path strategies.
Meaning they automatically adjust over time.
Yes, automatically shifting the underlying asset allocation from aggressive equities to conservative fixed income as the investor nears their target retirement date.
The convenience is undeniable there.
It is, but the source explicitly mandates performing X-ray analysis on the portfolio.
Wait, what does that mean in practice?
It means you cannot just accept the overarching marketing brochure. You have to pull the prospectus, identify the specific sub-funds the allocator is purchasing, and analyze them on platforms like Morningstar.
That sounds like a lot of work.
It is. You must verify the historical tracking error, the sub-advisor's alpha generation, and crucially, you have to manually calculate the aggregate expense ratio of every single fee layer combined.
Okay, I am experiencing severe cognitive dissonance with this advice right now.
Why is that?
Because if the entire value proposition of the FOF, literally the absolute only reason I am paying hundreds of basis points in stacked fees, is so that a professional allocator can handle the macroeconomic heavy lifting.
Yeah.
Why is the optimal advice telling me to spend my weekend performing deep dive forensic analysis on Morningstar?
That's a great point.
If I have to vet the underlying funds and calculate aggregate expense ratios myself, why am I paying an allocator 2% to press the buy button for me?
That paradox is exactly why institutional skepticism regarding funds of funds has grown exponentially over the last decade.
It just doesn't add up.
An FOF is fundamentally a tax on convenience. You are paying a premium to avoid the mechanical execution of managing a diversified portfolio, but you cannot escape the intellectual labor of monitoring the manager.
So you're paying for a service you still kind of have to do yourself.
Exactly. And the authors of our source material clearly recognize this inherent contradiction.
Do they offer a way out?
They do. They conclude by offering a direct alternative for investors who are unwilling to absorb the multi-manager price tag,
Which is?
constructing a synthetic equivalent using low-cost index funds.
Bypassing the overarching management fee entirely.
Precisely. By utilizing direct allocation into index funds, an investor can capture broad market beta, achieve massive global diversification, and completely eliminate the sub-advisory fee layer.
Because index funds are incredibly cheap to run.
Exactly. Passive index funds operate with expense ratios that are a microscopic fraction of a single percent.
Wow.
You achieve the structural benefits of the Russian nesting doll holding thousands of global assets without paying a massive premium to a macro allocator.
It effectively democratizes the diversification without the velvet rope markup.
That's a perfect summary.
So, to synthesize the core mechanics we've unpacked for you today, funds of funds, or multi-manager portfolios, offer an extraordinary level of automated convenience.
They really do.
They deliver institutional-grade diversification, spanning thousands of asset classes, and provide a literal backdoor to alternative assets that are usually restricted by SEC regulations.
They represent a marvel of financial engineering that scales institutional strategies down to the retail level.
The architecture is elegant, for sure, but the execution carries severe friction.
Very severe.
You are absorbing double-layered fees, structural illiquidity, and the hidden risk of redundant holdings. And over a decades-long investment horizon, a 2 to 3% aggregate fee drag is just catastrophic to wealth accumulation.
It really is.
So the next time you are analyzing your 401k options or reviewing a target date multi-manager portfolio, you now understand the mechanics operating under the hood.
You know exactly why you need to perform an X-ray on those underlying assets.
And you know how to calculate the true cost of that convenience.
Absolutely. And, I want to leave you with a final, slightly provocative concept to ponder as we wrap up this analysis.
Oh, I like where this is going.
We have established that a fund of funds is essentially a massively broad aggregation of the entire global market, structured to dilute risk.
Right.
But as a portfolio becomes infinitely diversified, its gross return simply mirrors the baseline performance of the total market.
Because you own a fraction of everything, so you just get the average market return.
Precisely. But you are capturing that average market return while dragging a 3% aggregate fee structure.
Oh, I see.
So the question becomes, mathematically speaking, doesn't an incredibly complex, professionally managed FOF practically guarantee underperformance when compared to a near-zero fee total market index fund over a 30-year horizon?
Wait, really? Guarantee underperformance?
Think about it. If you own the whole market and pay 3%, while the index investor owns the whole market and pays 0, could the ultimate diversification tool actually be structurally engineered to destroy long-term wealth?
That is a fascinating systemic paradox to mull over the next time you review your asset allocation.
It really is.
Thank you so much for joining us for this deep dive. If you found this breakdown of the multi-manager landscape valuable, remember to subscribe for more insights.
Just one click ensures you never miss a deep dive into the hidden mechanics of the financial world.
And please, share this discussion with anyone navigating the complexities of their own capital allocation. We will catch you next time.